So we've seen some remarkable things in financial markets in recent years, especially since the pandemic hit. We saw this crazy situation last year where people were willing to pay for you to take their oil. Oil achieved a negative price for the first time ever in its history. We've seen Bitcoin go from 4,000 to 40,000. And the latest episode in some of these remarkable stories is a small bricks and mortar retailer in the US called Gamestop. It's been the subject of a lot of speculation and discussion recently, but it's interesting to note that some of the discussion doesn't really explain exactly what's going on. So I thought I'd do a quick video to explain some of the detail behind it and how I think this will end. So the sort of world that we occupy now is very different from the one that we had sort of 20 years ago or so. I joined one of the very first internet trading forums for financial markets back in the 90s, before the internet was even really a thing. And we used to talk and discuss many different sort of things in there. But one of the things that would do the round very frequently was a scheme called a pump and dump. This is where people with, let's say, questionable morality would really talk up a stock as much as possible. But the thing about it is that they had actually bought into it before they'd started to talk it up. So they would really go out there and ramp the stock with the hope of pushing the stock higher, getting more people involved. But of course, they were selling on the other side of it. It was called a pump and dump scheme. And it was banned by regulators. Basically, if you went out to deliberately talk up the price of something just to improve your position, then you were in really serious trouble. Now, wind forward all of these years later, you have social media, you have forums, bulletin boards, I was going to say, that's what we used to call them. And the price rise on GameStop really came out of a subreddit called Wall Street Bets, where people started speculating on it. And of course, we've got the pandemic, people are at home, you can get zero commission brokers now. All sorts of things have basically sort of coincided to create this massive level of interest and activity within the markets. Lots of brokers going zero commission has really ramped up significantly the amount of volume that you see being traded on a daily basis. And I think it also is attractive to people who have never traded before, who probably had no awareness of what a pump and dump scheme was. But that sort of explains why there was some level of interest, a spark in this particular stock, but it doesn't explain why the price has gone absolutely crazy. So we should explore that and understand some of the detail of exactly what's going on. So when you're actively trading on financial markets, you can take a whole multitude of different types of positions, which I will attempt to explain now. But basically, if you buy something on the basis that you think it's going to rise, that's called going long. Basically, you buy something at a low price, you sell it at a high price, you make money. That's called going long. But you can also do something called shorting. It's much more prevalent in the US than it is in the UK. But you can actually profit from a stock falling in value. And the way that you do that is you go to somebody that has stock, you basically borrow their shares, then you sell them on the market with a promise to pay them the difference between when you borrowed the stock and when you actually have to buy it back. So the interesting thing about shorting is that when you look at buying, so say for example, you know, in the mid-90s, I was over in the US, I was sat at a table and we were discussing the impending bankruptcy of Apple. And I'll have to work out exactly how much it was, but basically you would have been able to buy Apple shares for just cents and the company was effectively worthless. Now, of course, Apple was the first company ever to have a valuation of over $1 trillion, and it's been going up and up ever since. So you could have potentially bought those Apple shares all the way back then and made an absolute fortune. If you look at Warren Buffett, he took over a company called Berkshire Hathaway that were a textile mill. He bought into Berkshire Hathaway at about $15 per share, and Berkshire Hathaway stock is now worth over $300,000. I actually own some Berkshire Hathaway. Unfortunately, I didn't pay $15 for it. I had to pay a little bit more than that. But nonetheless, you can see that these were fantastic investments. If you would have gone long on Apple or Berkshire Hathaway, you would have made an absolute fortune. So when you go long, what you're talking about here potentially is unlimited gains, but your loss is limited to the initial investment. So if you put £10,000 in Apple in 1994, you would now be a billionaire. But the maximum you could have lost was that 10,000 initial investment. However, when you short, the opposite is true. Basically, your potential upside is limited to 100%, but your downside is potentially unlimited. So can you imagine going short on Apple and holding that short position for all of this time? You would have lost billions rather than made billions. And this was one of the key factors that got people interested in Gamestop. Short interest is published publicly in US markets, so you can actually see how much of the stock is borrowed. In other words, how many people are actually shorting it at any one particular point or time. And Gamestop was right at the top of that list. There was a significant amount of short interest in Gamestop. And lots of people were speculating that perhaps that was overdone, and that if the fortunes of this company turned around at all, then maybe there would be a little bit of a rally. And that led us into the classic situation of a short squeeze. So when we're talking about a short squeeze, what we're talking about is there are lots of short positions in a particular stock. The stock rallies, and at that point, people who are holding the short position will have to make the decision about whether they choose to ride it out or whether they take the losses on those particular short positions. It's sort of the market can remain irrational longer than you can remain solvent. That's the most important thing to remember. And as a consequence, if you have a short position, it's more about timing than it is about the fundamentals. So what happened on the subreddit board was that basically people began to cotton on to the fact that if they actually had a long position and they could push the price of the stock up, then people that were short on it, which would traditionally be hedge funds, would be suffering financially at the back end of it and may have to exit their position. But the interesting thing is, this was the point at which somebody came onto the board, or they've worked out for themselves that there's also a thing that you can do that's called a gamma squeeze. And a gamma squeeze is when you use options to basically achieve the same thing. Now, I'm not going to go into great depth on traded options, but basically you can buy, or if you trade in or you buy a traded option, or you write a traded option, you have the right to buy or sell something at a certain price at some point in the future. So a gamma squeeze is when you start buying loads and loads of call options. And the problem that you have with a gamma squeeze, if you're on the other side of it, if you've written the option, is the more and more likely that that option comes or looks as though it will come into the money, then the best way to hedge your position against that, because again, you could face unlimited losses on that, is to actually buy the underlying stock and hedge your position that way. So you have a short squeeze, which is where a price rally puts pressure on the people who are short on the stock, and a gamma squeeze puts pressure on by forcing people to buy the stock to basically cover their potential liability if they've actually written that option. And what we appear to have had on GameStop is a combination of the two, and a large amount of interest within the market, and a lot of chatter and it getting into the press, and the whole thing just sort of ballooning from there. Essentially, this could happen on any stock, but because this was high profile and people started talking about it and then the press get hold of it, things sort of spiraled further and further out of control. So the interesting thing is, how is this going to end? What's going to happen from this particular point onwards? I think I pretty much know. Ultimately, the price that you put on a company is an irrelevance, really. It's all about how much cash that company can throw off and what its terminal value is, what assets are left when the company decides to stop doing business or eventually, gets taken over or something. So we can answer that question quite clearly with GameStop. They are running out of cash dramatically. That they're almost bankrupt, or it's likely that they would file for bankruptcy. It's unlikely they'll be able to raise any money. Nobody will want to be able to put money into a company that's about to go bust. And the game that's being played out here is that it's the greater fool theory. People are getting involved with GameStop now on the basis that the gains and returns are flying around all over the place, and they want to put 10,000 in to try and get 20,000 out in 2 days' time. But ultimately, all you're doing is messing around with the price. You don't change the fundamentals of GameStop, and the fundamentals are that if they file for Chapter 11 bankruptcy, your stock will be completely worthless. It doesn't matter whether you paid $300 for it or $50, you will be at the bottom of the pile when it comes to liquidating those assets. You'll get secured creditors ahead of you, and stockholders come right at the bottom. And this is one of the reasons that some broking companies have decided to restrict the ability to buy the stock, because ultimately, you could wipe out your entire account. And also in the US, people buy stocks on margin. So they use a bit of leverage to basically buy positions that could potentially result in them losing more money than they have in their account. So brokers have to look after that. And it either will directly affect the broker or the people who are underwriting that margin. Now, the big brokers don't have too much problem because all they do is change the margin requirements and push that back onto the individual investors. But there is a regulatory requirement that means that you can't let that get out of kilter, and that's why some of these companies are restricting trading on these particular stocks. So, I think that potentially you've got this dreadful situation where, in fact, everybody could lose a lot of money on this. But it doesn't matter to people who are in early. It's the same old, isn't it? People who are in early can cash out at enormous profits. It's the people who are left holding the can at the end of the day that are going to be the ones that suffer. And it's like a giant game of musical chairs. When that last chair gets pulled out of the way, anybody that's left with the stock is probably going to be the people that suffer the most and effectively fund all of the profits from people who bought it way back when it was $4 or so. I also think probably the Security and Exchange Commission may step in at some point or try and enforce some regulation or protocol around this, because ultimately, what we're looking at here is a socially media frenzy, which is now spilled out into the mainstream press, that looks just like a pump and dump scheme that I used to be very familiar with sort of in the mid-90s, and when all of the internet forums and bulletin boards were first coming around, which were regulated against. I don't see that much difference between what I'm seeing now and what I saw back then. But if you're not involved at the moment, I probably recommend that you don't get involved, but watch how it all plays out, because you'll probably learn a lot from that, which will put you in better stead when you see this sort of thing in the future. But that was part of the reason for doing this video, was to give you a bit of a warning, but also give you a bit of a better understanding of exactly what's going on and exactly how this could play out.